What's up, guys? It's Gavin Washington, aka Gav the Realtor, and we are back with another episode of Real Estate with Gav. You know, we talk real estate, finances, all that stuff that kind of ties in together. And today we got a special guest, my man, Mr. Quintez McDonald, lender with integrity. What's up, Quintez?
What's going on, man?
Not much, man. Tell us a little bit about yourself and what you do before we dive into it. And we're mainly going to talk about a little bit of credit stuff, but let Quintez kind of tell us a little bit about himself.
Yeah, so, name's Quintez McDonald-Gibson. Official title is Mortgage Loan Originator.
Okay.
Right. Disclaimer, we're talking about credit today.
Right.
I'm not a credit expert per se, but my team and I have over a decade of experience of helping people build, grow their credit, and repair their credit.
Of course. Yeah, that's what's up, man. So tell us a little bit about why credit is so important, first off, especially, you know, given that you're a mortgage loan originator, people come to you, they want to apply for home loans. Why is that credit score so important when they want to come do that?
Honestly, man, it's what we're seeing nowadays. You almost can't do anything without credit. Mm-hmm. You can't do anything without credit.
Yeah.
You can't get a rental. Can't buy a house without credit.
True.
Employers are running your credit now, which is crazy. I mean,
that is crazy.
Almost anything you do now, people are looking at your credit history. So,
wow.
You know, obviously with having a good credit score can do a lot for you in life, and I don't think a lot of people realize that.
Yeah. And talk a little bit about it with the loans. As we know, the basic loans, you know, like USDA, FHA, conventional VA, all those have a similar requirement when it comes to credit, right?
Yep.
So, like, what are you mostly looking for when somebody's coming to you? Like, what type of score might be like, okay, I can approve you for a home?
Now, a lot of lenders are different. There's lenders out there that tell you 580 and above.
Okay.
Is where they want. My company's looking 600 and above.
Okay.
You know, we used to do 580s, but that was a difficult situation to get in to do a 580.
Gotcha.
Because you're requiring them to put more money down, things like that. So we typically, as a company, look for 600 and above.
Okay, a little bit more secure for you guys, I'm sure.
Right. Absolutely.
Right. So tell me a little bit about the components that actually make up your credit score.
So the first thing is your payment history.
Okay.
Got to make your payments on time.
Yep.
That's 35%.
Okay, so that's the largest part.
That's the largest part.
Okay.
The next thing is you got to be able to the amount you owe. How much do you owe?
Okay.
You know, are you in underwater, as they say? Do you have a ton of debt? But the amount you owe is 30%.
Okay.
Next is your length of credit history.
Okay.
That's 15%.
All right.
Then you have 10% is your credit mix.
Okay.
Do you have a good credit mix? Do you have revolving accounts like credit cards? Do you have installment debts like car loans? Do you have mortgages?
Okay.
Right?
Gotcha.
And then the last 10% is just new credit. Are you opening a bunch of new accounts?
Got you.
Every time you go to a store, are you opening a new account?
Got you.
So that's the last 10%.
Okay. Does it hurt you to have too many accounts?
Yes.
Okay.
Yeah, because the length of time is 15%.
Okay. Got you.
So if you have a bunch of new accounts, then your credit score is going to be lower because you have so many new accounts.
All right.
Now, obviously, having a credit account is important. So you have to have something. So at some point, you have to have new accounts.
Gotcha.
I mean, that is what it is.
Right.
But you do. But having a whole bunch, like you have some people that are, any store they go to Lowe's, they go to Home Depot, they're opening a new account because they get that 0% interest.
Yeah.
And if you're doing that every time you go to a convenience store or something like that, then you're gonna hurt your credit pretty bad.
Got you. Okay. So how do you guys, as a loan office, obtain a credit report?
We'll get some personal information from the client. Pretty much all you need to run credit is name, social, and address.
Okay. Yeah. Cool. Now, does it hurt when you guys actually check my credit? You know, people say, you know, you get the soft inquiries or the hard inquiries.
Yeah.
Like, hey, I don't want my credit check because it's going to drop my score. Is that a thing?
Yeah. So hard and soft pulls, a hard credit pull typically is when you want a full lending decision.
Okay.
We do hard pulls because we're trying to get you fully pre-qualified to buy or even refinance a real estate.
Okay, got you.
Soft pulls are they don't affect your credit, but that's normally like your cell phone bills, your utilities.
Okay. Some
lenders say they can do soft pulls. My assumption would be if they're doing that, then it's not a full lending decision.
Right. Yeah. Exactly. Now, soft pull is something that your company would take a look at?
I'm sure we would entertain it, but most of the time, if you're coming to us, you're trying to do something serious.
Right, exactly.
We're trying to get to the end of the line here.
Okay. And with the credit report or pull of your credit, as some people call it, is it different? Or does the report look different when I'm trying to buy a house versus, you know, a car or a credit card, any of those other type of things?
So think of it this way. unless you're out buying Lamborghinis, when are you going to spend this much money?
Right,
when
exactly.
you buy a house.
Yeah, yeah.
So there's multiple different scoring models out there. Like FICO has multiple different scoring models. Isaac has multiple different scoring models. So the scoring models that you see on things like Credit Karma, Credit Wise, Equifax, Experian, all those guys have their own little credit. They're not as strict as what you would get when you're coming to buy a house.
Okay. So is the credit score going to look a lot different, or is it going to be somewhat close?
I usually say about 20 points. 20 points. You look at about 20 points off, and it can go either way.
Either way, up or down.
I've seen clients that had their Credit Karma was actually higher. Lower. I'm sorry. Credit Karma was lower. Normally, when you come to us, it's about 20 points lower than what you see on Credit Karma or Credit Wise or anything like that, because the scoring model is so much more strict.
Got you.
And Credit Karma and things like that, they're taking into account things that are not on our report that we pull.
Okay, cool. So, like, would you account like the Experian Boost app or whatever, like the same?
They're in that same category. They're usually higher. About 20 points higher than what we see.
Makes sense. Glad you touched on that, because that was going to be one of my questions. So we kind of got into that. One question that I get a lot, and I get mixed answers on when you should make your payment, all that stuff. But before we get to that, what is the difference between your statement close date and the statement due date?
That's a good one.
That's a good question, because I get people get tied up on this one.
That's a real good one.
Yeah.
So that's usually to deal with credit cards.
Okay.
Right?
Yep.
So the close date is the last date of your statement. So that's the last date. So if you make a transaction before that date, it goes on the current statement.
Right.
After that date, it's going on to the new statement.
Okay.
So that is the date that they start calculating your interest.
Okay.
Your due date is when you're liable to make that payment.
Got you.
Yeah.
Now, when's the best time to actually make your payment? Because some people will say, like, obviously you got that due date, and then some people will say you got to pay it before the statement closes, or whatever. Give me a little bit of tips and tricks on that.
My opinion on that is find out two things.
Okay.
Find out what your close date is, so you know when that interest is going to hit you.
Yep.
And then find out the date that they're reporting it to the credit bureaus.
Okay.
That's the next important one, because they're not always the same. Because what happened a few years ago, there was a big lawsuit on one of the big credit bureaus, with credit card companies. And what they were doing was your due date would be, let's say, the 21st.
Got you.
They reported on the 15th, right? So if you pay it on the 21st, they're going to catch you with your balance as high as possible.
Got you.
Which would allow them, if you have an adjustable rate, to lower your credit score and lower your interest rate. I'm sorry, raise your interest rate to give you a higher interest rate, charge you more interest. So I always say find out your close date, and then find out the date that they're going to report it to the credit bureaus. Not necessarily your due date.
Right.
But when are they going to report it?
Got you.
And know that.
So you want to pay it before they report.
Before they report it. Because that's less interest on you, and you can't get caught in that situation where, okay, my balance is higher, and now my credit score is going to go down, and now they're going to raise my interest rate and charge me more.
Got you. Okay. Now, another question I get sometimes, some people will say you got to have your credit utilization, which you kind of mentioned on there. You got to report something to them every month. You should keep your credit card. Yeah, you should keep your credit card balance below 25% or 30%, whatever it is. Yeah. You hear these different numbers all the time. And then some people say, like, you got to pay your balance off in full every month, nothing left on there. So are there any tips and tricks to that? Should you leave a balance on there, or should you pay it off every month?
So that conversation is going to be depending on that person's credit score. Okay. If you're coming to me and you're already at 800 credit score, then you've done your job.
Yeah.
There's no reason for you to report a balance. You can keep your balance at zero.
Okay.
But if we're looking at a growth mindset, or a repair mindset, then we want to report a small balance to show activity. Activity is very important.
Okay. Good to know. Yeah, because I get that a lot. Sometimes, man. They're like, I don't want to report nothing. And some people are like, now, when you say that too, while we're on that, the balance, is there like a number with that where you want to report some activity, like a percentage wise, like I mentioned, 25% or something like that?
Yeah. So the green zone, what we call it, is 10 to 30%.
10 to 30%.
10 to 30% is the green zone. That's the growth zone.
Okay.
That's when your credit score is growing.
Okay.
You hit 40%, that's kind of the gray area. Once you hit 50%, that's the red zone.
Okay.
And not the good red zone, like a lot of football.
So
once you start hitting 50%, the higher you go, the faster your credit drops.
Okay. Yeah. Got you. And with that 10 to 30%, that's 10 to 30% of your credit limit. Your credit limit. Credit limit. Got you.
And that's where we're growing. That's where we're in there and we're growing.
Got you. And if you have multiple credit cards, right? Would it be 10 to 30% of that credit card on each card?
You want to look at each one individually. That's another thing that people just look at. Okay, I have a total limit of this. So as long as I'm within 10 to 30% of the total, now that's not the case. Because if you have a small $300 credit card that's maxed out, that's hurting you.
Yeah.
That's hurting you. So it's each individual credit card.
Okay, that makes sense. Glad to know. Good to know. How does opening a new credit card or going to get a car or something like that affect your credit? Like, does it automatically give you a hit like whenever you open up something new?
Yeah, so we've said 15% is your length of history.
Right.
So opening new accounts does give you a drop in the beginning when you first open a new account because it's new, it's fresh.
Right, exactly. Yeah. Do you know like what we could possibly expect to see as a drop?
It all depends on what you have. So if you have someone 800 credit score, has multiple accounts, they got a good credit mix, that's 10%.
Okay.
Then that won't affect them as much as someone who maybe is just fresh.
Got you. Okay. Yeah. Now, how about when I pay something off? I've heard some people say like, I just paid my car off. I don't have a car note no more. And then they look like, oh man, my credit dropped or whatever. Is that a thing?
So installment debt. So we're talking car loans, any other type of loan that's not like a mortgage. They really want to see you take that from start to maturity. They want to see you take it all the way through.
Got you.
So if you pay it off early, sometimes it will drop your score.
Okay.
Which is sad. But
got you, yeah.
They want to see it go all the way through. You see it go all the way through, you'll see growth.
Okay.
But you do see a lot of people pay their installment debts off early, but it will drop you a little bit. And again, it depends on your credit profile. Where are you at?
Penalize us for being responsible, right?
Exactly. They want all the interest they can get.
Yeah, exactly. So a lot of what I've been seeing with new home buyers, especially, you know, in our generation, the millennials and younger, a lot of us have student loan debt. People like myself, I have a lot of medical debt from, you know, things that I've been through. Yeah. Does that impact you when you're coming in to buy a home?
Yeah. So let's hit those separate.
Yeah.
Let's start with student loans. That's the easiest one.
Yeah, let's do it.
So student loans, a lot of times, you get a student loan almost every semester.
Yep.
Right? So we just talked about that. That's new accounts, new account. Every time you get a new student loan.
Right.
They're pulling your credit and they're opening a new line of credit on your report. So you are going to get hit from that. As it sits there, especially if you're making payments, now it looks like you're taking an installment debt through that cycle.
Right.
So then it's helping you.
Yeah.
So you can see someone who has no credit at all, but they have student loans come in to buy a house, and now they do have a credit score because of those student loans.
Okay.
All right. But as they're getting them, because sometimes schools hit you with 4 or 5 student loans at once in one semester.
Yeah.
Because of the way they have it in their billing. So yeah, it will hurt you. Medical debt it's another thing that will hurt you.
Okay.
In our line of work, we're not going to mess with that. Where it's not going to affect you to buy a house. If you have a medical collection, it's not going to affect you in buying a house, but it will hurt your score if it's left untouched.
Okay.
Right. But with medical debt, that's probably the easiest thing to remove from your credit.
Okay.
So as of July 1st, 2022, they were supposed to stop reporting those to your credit report.
Oh, wait.
Right. And a lot of what I do is I help people repair their credit. So if we can get those collections off, that's a lot easier. So there's 3 ways to go about that. And it gets a little dicier as we go here. Okay. So the first thing is you just call them and say, hey, you know, you guys weren't supposed to be reporting this to my credit anymore. Right. And see if they'll take it off.
Okay.
Sometimes they will because they'll say, you're right.
Yeah,
it shouldn't have been on your credit report. The next thing is just kind of a negotiation. I owe you $500. If I give you $25, will you remove this from my credit?
Yeah.
And use your payment as negotiation to get it removed from your credit.
Okay.
The last thing, and this is where it gets dicey. This is where they start to sweat a little bit.
I got you.
And this is, a lot of people don't realize this. Having a medical collection is a violation of HIPAA.
I have heard this. Yeah.
So a lot of people don't use that. And I learned that from an actual credit expert.
Okay.
So like we just said earlier, your credit, when you go to rent, when you have renters, right, they run credit, right?
Right, exactly.
So if you're my landlord and you pull my credit and I have 50 medical collections,
right,
that tells you that there's something wrong with me or somebody in my family, right? So that may make you judge me.
Right, exactly.
Same with an employer. If you're trying to employ me and I have all these medical collections, you might look at me like, are they going to show up?
Right.
Right? So it doesn't tell you exactly what's wrong with you or your family, but having all those medical collections on your credit report says that there's something wrong with you or someone very close to you.
Right.
And that could cause an issue, which is a violation of HIPAA.
Yeah, discrimination.
Absolutely.
Dang, that's good to know. Yeah, because I have heard that before as well. So
you throw that out, you throw HIPAA out there to a collection agency. They're like, whoa, wait a minute. Time out.
I don't want to get in trouble.
You know what? You're right. Let's take it off.
Yeah, I got you. That's what's up. Glad to know it. Now, if I'm coming to you and I'm like, Quintez, I want to buy a home, but my credit's not the best right now, and I know I need to, get it up a little bit. What are some tips that you might help them with, or some place where you would be like, let's start here first?
So if they have stuff on their credit currently, then we're going to look at what they have and analyze their credit profile. If there's collections like we just talked about, if there's credit cards that are already there that maybe have the wrong utilization,
right,
then we're going to look at that. But if it's someone that has no current credit card accounts or current credit accounts, period, I'm going to give you a good one here. This is giving out all my secrets here.
I like it.
So Netflix.
Okay.
Right? Netflix. I'm going to say Netflix.
Okay.
Which would probably make people like, what? Netflix? Yeah. So here's what I do. Here's my biggest tool that I have in my tool bag.
Okay.
I'm going to tell you to get a secure credit card, right? A secure credit card is you want one that's treated as a typical credit card. They're going to take the security deposit. That's the secure part of it. And most of the secure credit cards will give you that money back as long as you make your payments on time for a certain period of time.
Gotcha.
So they take a $200 security deposit and give you an actual credit card.
Gotcha.
And then what I'm going to tell the client to do is I'm going to tell you to take Netflix or Hulu, Disney Plus,
whatever,
something, gym membership, something small but recurring. And I'm going to tell them to put that Netflix on that card and put nothing else on the card. And then I literally tell the clients, take that card and put it in your sock drawer. Don't use it for anything else. Nothing else. I don't want it in your pocket when you're at the grocery store and like, man, my stomach's bubbling. I'm hungry.
Yeah.
I don't want you to use it for anything else.
Yeah.
And then once a month, you let it report and then you pay it off. So yeah, you're going to probably pay $1, $2 more for Netflix than you normally would.
Right.
But that little tiny balance every single month is going to make your credit score skyrocket.
Like that.
Skyrocket.
Like that.
And that's probably the biggest thing we've used over the last decade.
Okay. I like that. And then, so like, if you're coming in with, you have credit, because you mentioning some people that might not have as much credit. So if you have credit and you got several credit cards or you got car loans or student loans and things like that, and you need to improve your score, where would you probably want to start with somebody like that?
So the biggest thing, as long as they don't have a lot of derogatory stuff, the biggest mover of the needle are credit cards. Okay. You can take a small $200 credit card, and that's going to do way more for your credit than $1 million Bugatti. That little teeny tiny credit card. And where people forget is, and where people mess up is, I'm going to tell you to start with the smallest one first, right? You have all these credit card accounts. You have all these, maybe you have negative stuff on your credit. Right. All that stuff is making you bleed a little bit. It's making your credit drop slowly, right? So what I'm going to tell you to do is let's get something pulling you up first. Let's take that small $300 credit card and let's get it in the growth zone. Let's get it in the green zone first. Got you. And then let's work our way up to the balances that are higher. But let's get something that's pulling us up first, because we got all this stuff pulling us down. Yeah. Let's get more pulling us up first, because our goal is to get to a house. Our goal is to get to a loan. I like that. Our goal is to get to a higher credit score. So let's get the smaller credit card first and get that one in the green zone. So now we have something pulling us up and we're growing. And then we start working our way through the rest of the credit cards. Okay. And then whatever I was using for that small credit card, I move it to the next credit card. Got you. The snowball effect.
Yeah, exactly. Yeah, I like that. I like that, because a lot of people would actually, I've heard others say, like, get the higher one first.
Go for the big one first.
Yeah, get the big one first. How long is that going to take you?
Yeah. And, not everyone has the assets to do that. If you have the assets to do that, by all means, attack it. But if you don't, let's work on the smaller one first, so we have something that's bringing us up, that's pulling us up, and not so much as pulling us down. Let's work our way to get to that balance. And then we move our way up, and now everything's pulling us up. Got you. Right?
I like that. Before we wrap up and tell people where to contact you, I want you to tell people a little bit more about yourself real quick, because I know you do a lot in the community, family man, things like that. So talk a little bit about that. And I know you're doing some coaching and stuff on the side. So people will see you out in the community. Tell a little bit about that.
I mean, I'm a big family man. Family first for me. It's all about family. I'm big on kids. I coach football. My wife and I run a youth organization. It's actually the feeder program to the Martinsburg Bulldogs. Okay. So we say we got about 180 kids.
Yeah.
So we always got them at our house all the time. We take care of all of them. Some of them are in need. We take care of them.
Well, you got a whole starting 5 basketball team at your house, right?
Sure do. And we love it. We love it. That's what we do. But then as far as that, we coach basketball, we coach football. Our kids are super in the, sports constantly. And we take care of all of our community kids too. We take care of them like they're our own. That's what we do. That's what we love.
Good to know, man. That's what's up. Yeah, we need more people.
You doing it too. You started to coach basketball.
Yeah, starting out there. I'm in basketball and soccer with my son.
That's
and
awesome.
It's
a good feeling.
It is good. You're giving back, because that's how I got started.
Yeah.
I had coaches that helped me that I looked up to. So now I'm kind of giving back.
Absolutely. And that's what you hit it on the head, man. Like, your youth coach is one of the most memorable people in your life.
Exactly.
So that's what we're trying to do when we coach basketball and football.
That's what's up, man. Glad to hear it. So if I'm listening right now and I'm thinking like, hey, man, I like Quintez. He's giving me some good tips on credit. I'm looking to buy a house soon and want to know what type of loans I could get approved for. Mm-hmm. Where can they find you? How can they contact you?
So our website is teamquintez.com. Mm-hmm. So Quintez is Quintez. So teamquintez.com. Mm-hmm. And then my cell phone is just 304-820-7630.
Gotcha.
Call me, text me, whatever you got to do.
That's what's up. All right, now y'all heard it there. If you need good credit repair, you need a good lender to reach out to trying to get approved for a home and know you need a good credit repair specialist, reach out to Team Quintez and they'll hit you up. And other than that, if you need real estate assistance, buy, sell, invest, you can reach out to me at 304-839-7040 or find me at Gav the Realtor, GAVTHA Realtor on all social websites. Quintez, thanks for coming out, my man.
Appreciate you, brother.
Appreciate you. And as always, y'all stay up and stay blessed. Peace.